All right, let's talk about silver charts. If you've ever looked at them and felt a little lost, you're in the right place. We're going to cut through all the noise and give you a really clear way to understand what the data is actually telling you. So, let's jump right in. So, have you ever been in this situation? You're looking at two different analyses of silver, and it feels like they're from completely different planets. One says a trend is locked in, the other says it's about to collapse. It's a super common frustration, but believe it or not, there's a pretty simple reason for it.
And there it is. You're not looking at one wrong analysis and one right one. You're probably just looking at two different maps. Think about it. One person could have a super detailed street map of, say, downtown Manhattan. Another person has a satellite map of all of North America. Both maps are 100% correct, but they're built to answer totally different questions. And it's the exact same thing with financial charts.
So, think of this explainer as your guide, your map to navigating the world of silver data. Look, our goal here isn't to give you a crystal ball or predict prices. It's to make you a much smarter, much more confident chart reader, simply by understanding the context that's hiding behind the numbers.
And just to be absolutely crystal clear before we go any further, this is all about building up your analytical skills. We're looking at history here. We're not promoting some kind of trading system. So of course, none of this should be taken as investment advice.
Okay, let's get into the most important concept of all. Seriously, almost every single contradiction you'll ever see in chart analysis boils down to this one simple difference. The difference between looking at what's happening right now versus what has happened across all of history.
So, on one side, you've got what's called the full sample view. This is the big picture. It looks at decades of data to find those really long-term stable patterns. But on the other side, you have the rolling window view. This one zooms way in, focusing only on the last couple of years to see what's trending right now. They answer different questions, and neither one is more correct than the other.
And the source material just nails this idea with a great quote. If you see two charts that seem to be fighting each other, your first question shouldn't be, okay, which one is wrong? It should be, wait a minute, are they using the same time window? Are they defining things the same way? Because, 9 times out of 10, that's where the disagreement comes from.
Okay, so we've got our framework down. Now let's actually put it to work. Let's take a look at who silver tends to move with in the market. Who are its key, let's call them dance partners, when you look at all that long-run historical data. But first, to kind of set the stage, let me ask you this. We all hear that silver is way more volatile than gold, right? But how much more? What does the data actually say about how much wilder its personality is?
The answer is roughly 2 times. Yeah. On average, silver's monthly price swings are about twice as wide as gold's. So a good way to think about it is if gold's price movement is like a big, powerful river flowing steadily downstream, silver is like class 4 rapids on that same river. It's generally headed in the same direction, but man, there's a lot more churn and turbulence getting there.
Now, to really understand these dance partners, we need a quick word on correlation. Don't worry, it's just a simple score from -1 to +1. If you get a +1, it means two things move in perfect lockstep. A -1 means they're perfect opposites. And a 0, it just means there's no real connection at all. Easy enough, right?
Okay, look at this. The big one to pay attention to here is that top line. Over the long haul, the US dollar index, you'll see it called the DXY, has a correlation of almost -0.5 with silver. That's a pretty strong negative relationship. It basically means that, historically speaking, when the US dollar gets stronger, silver prices have often tended to go the other way. It is one of the most important relationships to keep an eye on.
All right, let's add another tool to our belt. We're going to decode one of the most quoted and honestly most misunderstood metrics out there, the gold-silver ratio. It's incredibly powerful, but boy, is it easy to misinterpret. Don't let the name intimidate you. It's a really simple idea. The ratio is just the price of an ounce of gold divided by the price of an ounce of silver. That's it. The number it spits out just tells you how many ounces of silver you'd need to trade to get 1 single ounce of gold.
So how do we actually read this thing? Well, when the ratio is high, let's say it's 80, that means it takes 80 ounces of silver to buy 1 ounce of gold. In that case, analysts would say silver is relatively cheaper compared to gold. But when the ratio is low, say 40, it takes way fewer ounces, and silver is seen as relatively pricier. It's just a yardstick for their value against each other.
And with this ratio, context is everything. Looking back since 1971, the historical median, that's the 50-yard line, the middle point, is right around 63. But look at the range. It's been as low as 14 and as high as 113.
So when we see a recent number like 56, we immediately know it's hanging out below that historical midpoint. Now, that doesn't guarantee what's coming next, but it's like a GPS. It tells you exactly where you are on the historical map.
So, we've got our shiny new tools. Now let's talk about the traps. We're going to walk through 4 of the most common mistakes people make when they look at these charts. Mistakes that you can now totally sidestep.
First up, forgetting our 2 maps. Always ask if you're looking at a short-term rolling window or the full long-term history. Second, misreading that ratio. Just burn this into your brain. A high ratio means silver is relatively cheaper. Third, confusing the spot price you see on a chart with the actual price you'd pay for a physical coin, which always has a premium. And last, the hit rate fantasy. This idea that just because something happened 80% of the time in the past, it's a guarantee for the future. It's not. And really, this quote from the source material just sums it all up perfectly. History is an amazing guide, but it is not a crystal ball. What was true in the 1980s might not be true today, so you always have to approach the data with a healthy dose of humility.
Okay, we've covered a lot of ground pretty quickly, so let's pull it all together. What's in your new toolkit? Let's recap the key takeaways that are going to help you look at these charts with way more clarity from now on.
Here's what you've got. 1. Always ask yourself, is this the big picture full sample view, or is it a zoomed-in rolling window? 2. Just remember that silver is those Class 4 rapids, about twice as volatile as gold. 3. Keep an eye on the US dollar, the DXY. It's often silver's most important dance partner. And 4. Use that gold-silver ratio for what it is, a historical yardstick to see where we are, not a magic ball to see where we're going.
With these tools, you're not just staring at squiggly lines on a screen anymore. You're actually interpreting different maps, and each one is telling you a different part of a much bigger story. So the real question is, now that you know how to read the map, what will you see differently next time?